Hi, this is Jacob Hornberger, president of the Future of Freedom Foundation, joined by Sheldon Richmond, the vice president of the foundation. This is the Libertarian Angle, the show on the internet that brings you the libertarian perspective on the burning issues of the day, the perspective that we all know you're not going to get on the mainstream media, either in the newspapers or in the television and radio waves. Sheldon, the thing in the news, one of the things in the news is the expiration of Ben Bernanke's term as chairman of the Federal Reserve, and that Barack Obama is considering alternatives. So I thought, well, this would give us a nice opportunity to share with people the libertarian perspective and to show people how different it is that we libertarians think about these kind of things. Because, you know, the natural assumption in this whole discussion and debate that's now beginning to take place as to who Obama should appoint, what their beliefs are, and these prospective chairmen, what direction they're going to take the Fed in. They really ignore the entire libertarian paradigm, which is that we shouldn't have a Federal Reserve at all. There should be no central banking. There should be no central bank. And, I thought this would be a nice opportunity to discuss Hayek's notion of the competition in currency, the denationalization of money, maybe talk a little bit about Friedman's concept of the Fed and what he thought about it, and his proposals for reining in the excesses of the Fed. So I'll throw it back to you, but those were the types of things that I thought we ought to discuss today with respect to the Fed.
No, that's a great topic. It's going to be in the news back in June. This is a very strange story. I did a little Googling on this morning. Back in June, President Obama hinted, as the stories put it, that Bernanke was going to retire. His term is up at the end of January, but as far as I can see, there are no term limits. He could be appointed to another term. Greenspan certainly served more than 2 terms, and there wouldn't be speculation about his retirement if he had to retire, so that doesn't make sense. But I couldn't find any statement where Bernanke announced he was going to retire, or he hinted he was going to retire. It was always Obama hinting that Bernanke was going to retire. This was in June. The feeling was that he would the appointment would be made in the fall sometime, which gives the Senate time to deliberate on it, rather than waiting until January, I guess, when it's an election year and they want to give enough lead time, I suppose. So now it's back in the news that within a few weeks, Obama would be announcing his Bernanke's replacement, and the names being mentioned, none of the names are Bernanke. So there's no talk about having Bernanke stay on. By the way, his term on the Board of Governors itself doesn't expire until 2020. So he's serving two terms at the same time. One as chairman, which ends at the end of January, and one as just simply a member of the Board of Governors, which goes on for a few more years, 6 more years actually. So being mentioned are the vice chairman. The leading candidates are Janet Yellen, the vice chairman, and Lawrence Summers, who was the chief economic advisor to Obama in the first term, was Treasury Secretary and economic advisor to Clinton, formerly Harvard president, and who left under some controversial matters, but also still a professor at Harvard. So that's where things stand now, and we're going to be seeing more and more speculation about this.
Yeah, and like I said earlier, the entire assumption is that Americans should just take it as a given that the Federal Reserve is part of our structure of government, and the whole debate should revolve around, well, who's going to be running this particular structure, who's going to be the chairman of the Fed. And I think it's important that we look historically at what the Fed has done. I mean, the United States government lived without a Federal Reserve for more than 100 years. It came into existence, 1913 or so. And really, it's been the primary engine of inflation, of the debasement of the currency. if you look back from 1913 to today, there's a reason why the dollar is worth about 5% of its value as to when the Fed was brought into existence. There's a reason why quarters and dimes no longer have real silver content as they once did. It was because the Fed, decade after decade, has accommodated the massive ever-growing debt of the U.S. government, and by just essentially we call printing the money or expanding money and credit, flooding the money supply with newly created money, which of course devalues the rest of the money in society. And we've also got Mises's concept of the distortion that this produces, where they have injection points where they put the new money into certain areas where it inflates the bubble, like we've seen in the housing crisis. And so I think that's one of the major contributions of the Austrians, and to a certain extent reinforced by Milton Friedman, that the booms and busts that we've experienced, the recessions and the big, boom periods and then the busts come along, is really based on what the Fed's been doing throughout these many decades of existence. And I think we need to focus people's attention on the massive failure of the Fed, the destructiveness of it in terms of our economic prosperity and long-term economic well-being, in order to set the basis for a new paradigm that only we, the libertarians, are bringing to the table as compared to all the statists in the mainstream press.
Yeah, there was a great paper just a few months ago, or maybe the end of last year, by Larry White and George Selgin and a third author by the name of Lestrapes, I forget his first name right now, doing basically a report card on the Fed and looking at the U.S. economy pre-Fed and post-Fed, and not even in taking into account the pre-Depression period, the 20s, because that's typically by economists regarded as the practice round for the Fed, because the Fed was new. Like you said, 1914, it actually opens its doors. So even if you take out the 20s, where people say, well, they were just learning the game, the report card is very, very bad in terms of volatility, swings in the business in a business cycle, which of course is politically generated. In other words, it's not a natural market phenomenon. But even the swings, pre-Fed, we did not have a free market in banking. We did not have free banking. There was all kinds of government regulation, both at the federal level and the local level. But the Fed compares poorly to that period as well. And on a whole, range of criteria, the Fed's record is very, very poor. And they have the charts and the data to show it. Anybody wants to look that up, they'll be welcome. They'll find it easily. Put in White and Selgin and Fed report card, and you'll get it. I think maybe the Cato Institute published it. It doesn't look very good for the Fed at all. Now, as you say, that's not a mystery to libertarians and economists such of the Austrian school, because we understand that money should be market generated, and money, when the government takes over money, you're going to get all the kinds of distortions you'd expect when the government tries to preempt market forces. Interest rates, for example, are a phenomenon of market forces. And yet the government treats it as if it were some sort of physical lever that some wise person can, pull or push in order to get just the right effect on the economy. And we know that's not true. The knowledge isn't there. There's no such lever. They can try to influence rates, although I think it's overstated how much the Fed does influence rates. We have a very large economy. To think that the Fed can be setting rates is really a mistake. It's not to misunderstand the economy, but they can certainly put pressure upward or downward by what it does, and they have been doing that. But to think that they know the right rate, that's the big thing. To think they know what the rate should be is a pretense of knowledge, as Hayek called it, or the fatal conceit, to even use a stronger term. It's just like they don't know what the price of shoes should be or the price of housing, although they pretend to. They don't know what the price of borrowing money should be. And yet they persist on this. The mainstream still believes that they do know these things, and yet where's the evidence that they know it? Where's the evidence in terms of economic performance? Every time Bernanke hints that he's going to stop buying $85 billion worth of long-term securities every month, the stock market goes into a tailspin. In other words, the only thing sustaining this boom in the stock market is the artificial activity of the Fed to keep long-term interest rates down by buying up long-term government securities and mortgage-backed securities from banks. And the moment he hints that we may be winding this down, the market begins to collapse. How can anybody think that's real growth or real progress?
No, that's a great point. I mean, to me, this is just classic socialistic central planning. Just like the central planning that led to such massive distortions in the Soviet system. You've got this central board of essentially commissars that are deciding, planning one of the most complex, intricate matters in a market economy that one could ever conceive of. I mean, the monetary system. Imagine, a board of governors or commissioners really pretending to have the requisite knowledge, no matter how many computers they use, that deal with financial aspects all across the board. It's absolutely ludicrous. I mean, how can it be surprising to anyone that things are such a mess economically when you've got this kind of socialistic central planning taking place in the monetary sphere? And it's interesting you bring up the economy, because here you've got Barack Obama starting this tour about talking about the economy and lamenting about how people are suffering, the poor are suffering. Well, if you take this in a larger context, all Barack Obama's doing, whether he realizes it or not, is indicting the whole welfare, warfare state way of life that has this engine of the Federal Reserve along with the IRS and the income tax to fund it. They've had how many years to wage their war on poverty since the 1960s, and to a certain extent the 1930s. They go back to the Roosevelt administration, where you have this massive turn in policy toward the federal government taking care of people and spending and borrowing and so forth. But look, they've had decades to get their act together. And yet now what is Barack Obama telling us? Well, the poor are suffering. Look what's happening. Well, of course they're suffering. And it's primarily because of this welfare warfare state way of life that sucks massive amounts of capital out of the private sector, diminishing people's standard of living. And then you've got these artificial booms and busts. And look what they're advocating: more spending, more borrowing, and more inflating from the Federal Reserve. And they're hoping, well, if we can just have one more fix, this is the key to prosperity. Well, as you know, and as we libertarians have pointed out, the Austrians have pointed out, this is not real prosperity. It's fake, artificial prosperity that pumps up a balloon, gets everybody excited, makes it look like, oh, this is going to be a great deal, and then bust. The thing comes along, and what do? They start lamenting again. They blame it on the free market, and they start advocating the same type of thing. And I'm just not convinced that this can keep going on indefinitely. That they may have finally reached a point where the body politic cannot recover from this heavy burden of welfare, warfare, and Federal Reserve expansion, inflation of the money supply.
Well, yeah, there's a lot going on, right? And so let me say a little bit more about the Fed before we get into the economy general, because that seems to be where you're headed. But the Fed, of course, has been creating a lot of money, but at the same time, it's been paying the banks not to do anything with the money. So beginning in 2008, and for the first time, this was supposed to come in around 2012, but they accelerated it. They started paying banks to keep the new money in their Fed accounts. Any bank that's a member of the Federal Reserve System has an account at the Fed. And so instead of just giving the banks the money and saying go lend it out, which really would have set in motion a new boom, it didn't do that. It paid them 0.25% interest. And so, for the most part, the banks have left it in their account. There was more certainty, and under those conditions, a better return to leave it in their Fed account than to lend it to business, which was reluctant to borrow anyway, because for a lot of reasons like Obamacare and Dodd-Frank and just other things. What were taxes going to be next year? That uncertainty kind of froze investment, made people reluctant to invest. But so there was little demand or little supply for loans. And so the Fed, it sounds like a bit of a schizophrenia, right? Creating the money, but then paying the banks, basically bribing the banks through interest payments to not put the money in the economy. That's why we're not seeing some raging runaway inflation. We're certainly not seeing that. Now the question is, what happens when what if the Fed decides not to pay interest anymore? Or whether, well, let's say optimism seems to pick up for some reason and people want to borrow the money and the banks decide, well, it's a better deal to lend it out than to keep it in the Fed account. Then we'd begin to see the distortions from inflation. Now, the Fed promises that it'll move in and sop up all this stuff that they've been, sop up the money that they create by buying these securities. But the question is, how do they do that? Typically it sells securities when it wants to take money out of the economy. But if it's holding securities that nobody wants, like mortgage-backed securities that maybe are dubious, then how is it going to sop up the money and get it out of the economy before it does create upward pressure on prices and distortion? So all those things are going on. And one other thing I want to mention before we leave the Fed, as Jeff Hummels pointed out, Ben Bernanke has been quite an innovator. We shouldn't just say he's just another in a long line of inflationists. He did something that no Fed chairman has done. He turned the Fed into a central allocator of credit. It's a central planner for the allocation of credit. It has directed credit to particular firms and particular industries, which is something new. In the old days, pre-Bernanke days, the Fed would create credit, but then from there, market forces would determine where that credit ended up once it got into the system. But the Fed has found devices to actually channel it in particular ways, and that's dangerous. That's terrible. It's a terrible precedent. But if we're going to find an innovation that we should, note for Bernanke, that's it. He's turned the Fed into a central allocator of credit.
Yeah, well, one of the interesting aspects of this is the variations between the Friedman school and the Austrian school, and then, of course, I guess we could call it the statist school. But Friedman, as you know, used to call for a fixed increase in the amount of money and credit that the Fed could do. So to avoid any massive inflation, I think he had like a 3 or 4% increase in the amount of money that could be inflated into the system. And he was calling for a constitutional amendment that was really complicated in that sense. And he got criticized by the Austrians, saying, what do we even need a Federal Reserve for? I mean, it was admirable that he was trying to constrain the Fed with some type of constitutional prohibition, but really the Austrians went to the root of the matter and said, what do we even need a Fed at all for? And I think that had to have had a big influence on Friedman, because later on in his life, I recall seeing an op-ed that he wrote in the Wall Street Journal saying, look, here's my proposal for the Fed. And then he put in parentheses, my big proposal is to abolish it. And I thought that had to have come from the Austrians, that's really his ultimate ideal, was to abolish it. And I think that's one of the distinguishing characteristics between libertarians, Austrian economists from the statists, is that we don't want a Federal Reserve. And this is essentially what Ron Paul was saying throughout both his presidential campaigns. You don't need this type of thing. You don't need the destructiveness involved with this type of central planning, socialistic type organization that has been so destructive to the American economy. And Friedrich Hayek, who, of course, won the Nobel Prize in economics, came up with this notion of the denationalization of money, where instead of having a gold standard, which in my opinion is the second best ideal, where people are using gold and silver coins as the medium of exchange, and the government sets that as the official money, so you don't have the risk of government overinflating with paper fiat money. But the ideal, I think, is the Austrian paradigm, where you have a free market in money. Let the market decide what medium of exchange people want to use. They might use gold coins. They might use silver coins. They might use American Express banknotes. They might use any combination of things, or really things that we never even have thought of. And I think that's what we bring to the table. We're not here talking about who should be the better Fed chairman. We're talking about what is a better system, a system that is consistent with freedom and prosperity. And that system is monetary liberty, Sheldon.
Well, and in arguing against the mainstream, we have to keep in mind that this is a mainstream that doesn't believe that markets do what economists, for a very long time, even before Adam Smith, understood that they do, namely regulate themselves when it's permitted. I mean, basically since Keynes, the mainstream of economic thought has denied that markets actually engage in sort of a self-adjustment that keeps things generally going pretty well. They don't believe that. They think that's the exception. They think the rule is the economy's in a ditch and can't get out on its own power. That was a big change in economic thinking. From Adam Smith, but although you can go back to the Middle Ages and find people arguing something very similar, all the way up to Keynes, basically. That was the main line of economic thinking. Here I'm drawing on work by Pete Boettke in his very good book, Living Economics. He explains how this idea that of self-regulating markets, when the government stays out of the way of things, the market runs fairly smoothly, and nothing's ever perfect, so that's not the point. But it does adjust, and it does solve problems through entrepreneurship and people, making these adjustments. That you get these market forces that are constructive, overall benign. And it's with Keynes that you then get this new view, which he calls the mainstream, but not the main line of economic thinking, that says no, markets really don't work. Markets don't really operate. It's almost like denying there is such a thing as a market, because they think you need an external force like government to keep the thing going. And the same, they would say the same thing about money. They would say, what do you mean money and banking can operate without the government? That's ridiculous, they would say. However, we have some historical examples, and Larry White has written about Scotland, for example, in the, I guess it was the 18th century, maybe, forget exactly when, where free banking, no government involvement whatsoever, no government gold standard, and this system worked very well for a substantial amount of time, until the Bank of England decided it didn't like it. So we know it works historically. The theory tells us it works also. There's no problem there. But you have people who have locked on to this idea that markets cannot work without the heavy, visible external hand of the state. And they're sticking to that story, even though their record is terrible.
Well, as you know, there's in the Austrian movement, there's this division with respect to those that believe in a 100% reserve standard of the banks, where apparently the government either imposes a standard or it's just a standard that people are expected to comply with because it's supposedly based on some notions of fraud, where the bank cannot engage in fractional reserve banking. And my thought has always been that as long as a bank discloses fully and above board what it's doing, that it should be able to engage in fractional reserve banking, which is essentially saying that they may have, let's say, $10,000 on deposit and be loaning out at any particular time, say $10,000, because they figure that not everybody's going to be coming and asking for their money. But as long as they're disclosing to customers that they're doing this, I don't see any fraud at all involved. Fraud involves where you're misleading people. And if somebody wants to take the chance and put their money in a bank that's doing that type of thing, they take the risks. And we've got this system now that treats banks in a privileged position, that they're not permitted to go under and people don't lose their deposits. And really, I think what you end up doing is you create an across the board weaker system, an unstable system. Because if there's an industry-wide banking collapse because it's become so weakened, I guarantee you that deposit insurance ain't going to do a bit of good at all. And so my feeling is let the banks engage in fractional reserve banking, leave people free to put their money in the safer banks that are not doing that or doing it to a lesser extent. If your bank goes under, then you take the risk that you may have to bear some of that loss as a depositor, as well as if you're a bank stockholder.
Yeah, you brought some good issues together there. Where banking has been allowed to be free, it's been fractional reserve. And the reserves were not very high. Now, Mises used to think that under free banking, the reserves would be very high, like 80 or 90% or something like that, just through competition, right? Keeping every bank being worried that it would suffer a run, competition would force up the reserves to the point that they were quite high, getting close to 100%. But in terms of practice, like in Scotland and the other examples that White has written about, they're actually quite low, like 2 or 3%. That seems pretty amazing. But banks competed for reputation, and they had devices built in that the depositors understood in case the money wasn't there the day you showed up. there would, in your contract, it would say they could then have 30 days to produce your money, and you get interest over that time. Well, that must have been perfectly acceptable to the depositors because they were patronizing those banks. It's kind of a myth that banking arose, fractional reserve banking arose through deposit, warehouse deposit fraud. In other words, the story has it that banks originally were warehouses, like the safe deposit box, right? You brought your gold to a warehouse, they gave you a receipt for it, and you understood that it was going to be there. Just like if you take jewelry to a safe deposit box and put it in there, they don't lend out your jewelry. Okay, that's yours. That's your property. It's not like putting just cash in. So people thought, people mistakenly think that's how banking got going. One day, some smart banker said, "Hey, I got an idea. That guy's not going to come in for his gold. He never comes in for his gold. It's heavy. He doesn't need to move it. He knows it's safe here. I'm going to lend out some of the gold, or at least certificates based on that gold." And now 2 guys are walking around with certificates for the same gold. Aha, but he got away with it, so it kept growing. But that's not how banking arose. Safe deposit or warehousing was a totally separate industry, and people understood it. They distinguished that from banks. They knew a bank was not the same thing as a warehouse. They weren't stupid back then. And the reason they were willing to put their money in a bank rather than a warehouse is because they got paid interest to do it. And they thought it was worth their while. Now, you made a point about the deposit insurance, which is if you had to do one thing today, it would be get rid of deposit insurance, because people would once again care about where they're putting their money. Most people don't have to think about how responsible the bank will be with their money. Why? Because there's a sticker on the door, a decal that says your deposit's insured by the Federal Deposit Insurance Corporation. And so people don't need to think about it. How can that be a good thing? Don't we want people caring about what their bank is up to? Banks used to go to great lengths to assure the depositors that they were very serious and responsible and sober about what was done with their money. It doesn't have to work that way anymore. It hasn't for quite a long time. Interestingly, Herbert Hoover and Franklin Roosevelt both opposed deposit insurance. And Roosevelt, after he was elected, but before he was inaugurated, was asked about deposit insurance, which had gone on in the States, that was being talked about at the federal level, and he said, "I agree with Hoover. I'm against it because it'll just reward irresponsible bankers." Now, he ended up signing the bill. I don't know if it was a bill that had that as among other things, or whether there was a standalone bill. For whatever reason, he ended up signing it. But he did have the right position on it not very long before that.
Yeah, well, you brought up Hoover and Roosevelt. I think we'd be remiss if we didn't mention the Great Depression and the great stock market crash before we sign off today. I mean, when we were kids, we were growing up and we were taking our little economics classes and history classes, they always told us that the Great Depression was the failure of the free enterprise system and that Roosevelt's New Deal saved the free enterprise system. Well, thanks to the Austrians, when I finally discovered Mises and Rothbard and Hayek, I realized I'd been lied to. It was all a big lie, and to a certain extent, Friedman as well, who wrote his tract on the Great Depression. That the stock market crash in 29 was a direct result of the Federal Reserve. That's what brought about that stock market crash and ultimately the Great Depression. And that's not free enterprise. That's central planning, as we were discussing earlier. And so here you have the greatest depression in our nation's history. That's part of the Fed legacy. And I think that's another contribution that the Austrians, especially with Rothbard and Hayek and Mises and then Friedman, have brought to the table. What do you think, Sheldon?
Yeah, it's a great story, and there's the famous story of Bernanke being at Milton Friedman's birthday party and saying, "We learned our lesson. We apologize. We learned a lesson from you that it was the Fed's fault. We apologize." Famous story, told many, many times. Friedman in his famous book on the monetary history of the United States with Anna Schwartz pointed out, I mean, his argument was, he doesn't say much about what created the crash in the 20s. The Austrians have plenty to say about that, but he points out that what made the downturn and a recession a Great Depression, and you can divide these things up, was the fact that the Fed, the money supply collapsed with banks withdrawing, calling in loans and taking money out of the economy, and the Fed stood idly by, according to Friedman, and didn't provide the liquidity to offset the collapse. there's controversy among Austrians about whether the Fed did that or not. Of course, the Feds say the Austrians say the whole thing got in motion because of federal attempts to keep credit cheap during the 20s, which was a favor to business, which it was doing. Even though there wasn't price inflation because of technological innovation and expansion of productivity and expansion of supply of goods, the Fed was trying to keep money cheap for business. And that led to the stock market bubble and then the crash. But then you have to talk about what happens after that. And so you have Friedman coming in with the Fed stood idly by in the face of a collapsing money supply. Rothbard takes issue with that. So there's a lot of argument there that I'm not an expert on and would take a long time to fully talk about anyway. But it's interesting stuff to talk about. The point is, if there hadn't been a Fed all along, or if there had been free banking, we wouldn't have had the Great Depression, and we wouldn't have had the collapse or the bubble, because we're seeing, we've had bubbles ever since that haven't led to something like the Great Depression, but nevertheless have created a lot of misery. I mean, a lot of people suffered with the 2008, credit collapse and all that problem, and the most vulnerable people get hit. They lose their jobs and then don't find them because the economy's not producing a great number of jobs, and it's one big mess which would be cleared away if we simply went to market money and did a whole lot of, removal of privilege and regulation from throughout the economy. It's not just one thing. You really have to look at it comprehensively.
Yeah, you're right. I mean, they still, when things are going wrong with their system, they always blame it on free enterprise, that the free market has failed. And to a certain extent, they get away with it. Except that's where we come in as libertarians and Austrians, that we don't let them get away with that anymore. And I think more and more people are discovering that, both on the left side of the political spectrum and the right side. But anyway, that wraps up the show. We're out of time, and thanks for tuning in. If you're not familiar with the Future of Freedom Foundation and you've seen this video, come and visit our website at fff.org. We've got a free daily publication that we put a lot of time into. It's called the FFF Daily. You can subscribe online. We've got a fantastic monthly journal that Sheldon edits called The Future of Freedom. That's $25 a year, or $15 for the email version. We're all on Twitter, Sheldon, myself, our program director, Bart Frazier. We've got an FFF Twitter feed, so you can subscribe to that. Come visit us on Facebook. We have a lot going on there. So get familiar with the Future of Freedom Foundation, and you'll see that this is one outfit that presents an uncompromising moral, philosophical, and economic case for the free society. Thanks for tuning in, and we'll see you next week.